It says 65.00%. 65% of retail investors trading CFDs with them lose their capital.
So the core principle, the axiom driving this whole calculation has to be this. Your capital requirements must be driven by conservative risk management.
Specifically based on your defined maximum acceptable drawdown, your MPD, and absolutely not by whatever low minimum margin the broker sets.
We're defining sustainable trading capital, CPK. And this analysis breaks CPK down into three essential components. We have the initial margin, or IM, then the risk buffer, RB, and finally the operational reserve, OR. Now, before we dig into each one, we really have to hammer home the difference between that initial margin, the IM, and the full CPK. Because they sound similar, but they mean totally different things for, well, survival.
The total financial reserve you actually need to survive the inevitable market volatility, the long sequences of losses. CPK is what you need to endure that without the account blowing up. RB, the risk buffer, does the heavy lifting. That's the capital specifically set aside to absorb the maximum expected portfolio drawdown. This is your real risk management money. And then OR, operational reserve, covers all the trading costs, commission, swap fees, even potential slippage budgeted specifically to, keep the lights on during that whole drawdown and recovery phase. Okay, now we arrive at the real heavy hitter, the heart of this CPK calculation. The risk buffer, RB.
This is the pillar designed purely to protect the account against the statistical reality of losing streaks, of serial losses. If IM is the entrance fee and OR is the running costs.
RB is the actual financial armor. And this is where we finally bring in your personal risk tolerance, your maximum acceptable drawdown, MPD. It's the maximum percentage loss from your peak capital that you are willing to tolerate before you say stop, pull the plug on the strategy, or reevaluate everything. But the risk buffer, the RB, must be calculated specifically to ensure that even if the market throws its worst statistically probable curveball at your portfolio,
You don't cross that MPD line.
Okay, wow. We've broken down all three pillars now, IM, OR, and the big one, RB. If someone listening wants to apply this kind of framework, what are the key pieces of information they absolutely need to have or calculate, right? The inputs for the model. You absolutely need, first, your chosen maximum acceptable drawdown, MPD. Second, you need the historical performance data for each individual strategy, including its maximum historical drawdown, MHDD, to feed into the correlation analysis.
Got it. Third, the crucial piece, the calculated correlation matrix, showing how all your strategies' returns interact with each other.
And fourth, you need a realistic estimate of your expected monthly trading volume to properly size the operational reserve, or R.